October 26th, 2023. Today, if you look from bar 18 to essentially bar 27, this is all an attempt at a wedge, right? The bulls were trying to create a wedge down here. And sometimes what happens is you get a breakout below that wedge, like we got here on 31 and 32, and you get a measure move down of the wedge. And that's where we went to today. Additionally, up here, I thought it was okay to sell up here because 90% chance you're going to break out of the opening 18 bar range. So if you know there's a 90% chance we're going either here or here, it's reasonable to take the short, looking to get out somewhere down here. And I went through through the math yesterday. I scrolled through a bunch of old days, and there's a 83.5% chance that you break out of the 36 bar range. So the probability from the 18 bar range breakout to the 36 bar range breakout doesn't drop all that much. Probably because you're in a trend usually by the time you're at bar 36 or somewhere near the higher low of the day. So it's not surprising it breaks out. But I want to talk a little bit about these trading ranges and why you can go from something like this to immediately something like this. And the reason is that it's a trading range. And what happens is bulls will be buying. They'll be buying down here low in the trading range, hoping that we start to rally. And when they do get the rally, as it goes on further and further, bulls get tighter and tighter with their stops. So as their open profit gets bigger and bigger, bulls generally will tighten their stops more and more. And when you start getting the best looking part of the move very late in the move, bulls will pull their stops even more tight. So they'll, some bulls will be buying all these closes, but they'll, if you buy the close of 65, your stop's below 65. If you buy the close of 66, your stop's probably below 66. You buy the close of 67, your stop's below 67. Why? Because this is a pretty parabolic move. It's a tight channel, but it's a pretty parabolic move. And, when that happens, a lot of times, a lot of traders are sitting there waiting to exit the moment we trade below the prior bar. And that's exactly what happens here. We trade below this bar and traders start dumping their longs immediately. Why? Because they have a big open profit. And, if we get a second leg up here, it's probably just going to test somewhere up in here and let those traders out. Same thing it did over here. You can see we got a strong rally on this, but then bulls were disappointed in 18 and they exited around break even during the tail of 19. And this is bulls selling out of longs, what's causing this big bear bar. A lot of times, actually, I'll discuss that in a minute, but I want to finish making my point on this. And so bulls selling longs is going to cause, 68 and 69. And when you see 68, any bulls who aren't getting out immediately below a bar are going to exit below 68 because, again, it's a super parabolic, 3 pushes up, top of a trading range day. We've been getting lower highs all day. Makes you think we're going to get another lower high. And so maybe even a reasonable sell below 68 and definitely a reasonable sell below 69 after you have follow through. And bears are doing the same thing that the bulls were doing in here. Bears know that this channel is pretty tight and it's reasonable to think it's going to get a second leg up. And it's pretty late in the day. So they'll sell maybe below 68 and definitely below 69. But when they're selling, they're hoping that we kind of just collapse like we did and they'll put a stop above 69. When you get bad follow through like 70, some might even put a stop, a tick, or maybe a point above 70. And that's why it never trades above because traders weren't letting it trigger. And they sold more. And you can see it continued down. And then once it vacuumed down, the close of 75, you can see those traders basically started giving up pretty quickly. Because why? Because we saw a bull bar. When you get a bull close on 76, traders just flattened immediately, and that caused the bounce on 77. And if you look at the low of 77, it's one tick, or is it one tick? I believe it's one tick. Yeah, it's one tick below the low of 75. So traders sold below 75. We're disappointed in 76 and exiting at break even during 77, and that's causing the bounce. And we're actually getting a final flag right now. It's an expanding triangle. We had, a lot of expanding triangles today. And really, they're a lot of times continuation patterns, but like here, they were trying to get a reversal and we ended up getting the breakout below. And since, this expanding triangle makes you think it's a bull flag and you get the breakout below the bull flag and the measure moved down. Here, you can see they tried to get a major trend reversal. Here, they did get a major trend reversal. And again, here, I think bulls are going to try and get some sort of bounce. Main reason being bulls who bought the 67 close did something reasonable. If you buy a reasonable close, there's a 60% chance you're going to get back to that price. So 60% chance we get back to this 41.90 price, and 80% chance that we get to the midpoint of, the next reasonable bull bar to buy. So let's just say, in theory, it's reasonable to buy above 79. 80% chance we're going to get to that midpoint. Tomorrow, if there's a good bull bar closing near its high, let's say right here, 80% chance we're going to get to that midpoint. So Reasonable to think that tomorrow we're going to rally and get a second leg from this really tight channel and just be in, I think, pretty obvious resistance, probably at the low of 67 more than the close, because limit order bulls will be buying below. So probably sellers whenever we get back up here. I think that was all I wanted to go over on that. So bar one, good bull bar closing near its high. Bar one does something important in that it overlaps with yesterday's low. So automatically right off the bat, the bulls who bought below Wednesday and were willing to scale in are now able to get out of their trade with a profit. So they buy below here, they buy more lower. Limit order bulls are making money, which immediately makes the bear case less strong. Big follow through for the bears on two, but it's probably mostly just limit order bulls taking profits. And now you're at the bottom of a tight trading range with bar one and bar two. So probably not that many sellers below two. And you can see it was a one tick trap below two. And then we got a big reversal up and an outside bar on three. Even if bar three closed on its high, it's a tight trading range. So it's not a very good buy. And you know that you have trap bulls or trap bears who sold below two. And those bears are going to be able to scale in and make money since it's probably a trading range. If we start to really rally, so for example, by the way, if we had a bunch of time left in the day, expanding triangle, inside bar, it's probably a reasonable buy above 80 if we had more time in the day. Obviously, you don't want to do it with one bar left. And, you'd say 80% chance we're going to get here. So that, that's probably a reasonable scalp profit target. But as I was saying, bar four, big bear bar closing near its low. And you can see it gets back to about that low of three, or that low where those traders got trapped. So any of the bears who were selling that's below two, disappointed in three, and they're exiting, around break even during four. And that's causing the big tail on five. Five also acts as a pause bar. Five also acts as a pause bar. So if you sold this bar below four, five is not ideal. And you get a good follow through bar on six, which is good, but there's kind of a lot of problems with it in that, one and three were pretty strong. And while bar six is pretty strong, it seems more likely that we're going to start to pull back because of the tight trading range. And when you get a pause bar here, you can think of it as one pullback, two. So it's one pullback, two. So it's a two-legged correction. So could be a trap. More follow through on bar seven, and then an inside bar on bar eight. There's big tails here, small tail, but big tails. So we have a couple of big tails here. And then if this is one pullback two, and then you could get pullback three. So this could be three pushes down. So eight, maybe you sell hoping we get a breakout to the downside, but it doesn't seem super likely that we're going to get that breakout. Bad follow through on nine, it's an inside bar. So now you have an II pattern, and bulls are hoping we're going to get the upside breakout. Bears are hoping we're going to get downside breakout. It's relatively 50-50 at this point. Maybe with a small edge to the upside, I would say, because maybe it's 55% to the upside because this is a tight trading range. We're in another tight trading range. It's a trading range day, and all we've done today is go down. So if it's probably a trading range today, and all we have done is go down, then where are we probably going? Probably going up. Disappointing that 10 breaks out of the II. So bulls want them to break up to the upside, or I don't know if you guys were watching, but bar 10 was an inside bar until there was about 10 seconds left in the bar, and then it broke out to the downside, which is disappointing. Traders wanted to see it stay in an inside bar and get an II pattern, and that is a triangle essentially on a smaller time frame. It's just something like this on the smaller time frame. 11. Bad follow through. 11, kind of bad follow through. If you're selling below 10, you don't want to see a big tail. You don't want to see a small body. You want to see a big follow through bar for the bears. And you can see we couldn't even close at a new low. So it's a failed breakout of the II. And 50% chance the first breakout fails. Bears are assuming this is going to fail. They'll buy back shorts at the market, and that causes the big bounce on 12. We break out to the upside of the II, so we're break out to the upside of the trading range. But big tail on the top of the bar, and it's a tight trading range, so disappointing. Any bulls who were front running this, hoping the bar would close on its high, scalp out on the close of 12, disappointed there's a big tail on it. We get an inside bar closing near its low on 13. Probably going to get some follow through, but not sure how much we're going to end up getting. You can argue, that 13 being an inside bar is a reasonable sell, and you're hoping that we're going to get a measured move down of the bull flag. And I get the argument. It makes sense. But 13 should close stronger if that's going to be the case. I think that 13 needs to close on its low. This just looks like it's going to be a spot for bears to buy back shorts, and they're already starting to buy back shorts around here. So if 13 is really strong and closes on its low, then I think it's better, but it doesn't. And so when you get bad follow through on 14, bears are immediately disappointed, and they know bulls were buying this low, and they're probably going to continue to buy because bulls, this isn't ideal for bulls, but you're happy that bears were not able to get a strong close at a new low. And so bears are going to be buying back shorts, and that causes the rally up on 15. 15, it's still a tight trading range, but I think it's reasonable to buy above 15 and hope to add on more higher. If you're buying above 15, you're hoping you're going to get essentially a measured move up. And, it's possible we have to test the 14 high because you're buying a breakout of a tight trading range. And if you're buying a breakout of a tight trading range, you want there to be fast follow through because it's low probability. If you're risking 13 points to make probably 40, there's maybe a 40% chance you get there. So the math is okay to take the buy above 15, but I would buy smaller and look to add on above good bull bars. Like 16, you get 15. What's your ideal follow through bar on 16? What does it realistically look like in your head? It looks like 16. 16 is pretty much perfect follow through. It's exactly what you wanted. But 17 is really disappointing. If 15 and 16 are so perfect, then why is 17 so small? Sometimes you get a pause bar and then you continue up, and you have to consider that. But, why is 17 so small if 15 and 16 were, picture perfect? 15 was great, and obviously 16 was picture perfect follow through. And then you get 18, and 18 trades below 17, and it's a bear close. Usually you get a couple of runaway winners on the week if you're a swing trader, and this had potential to be one of them. But why are we already getting a pullback? This makes me think that we're probably going to get 2 legs up, and we're still in a trading range. So not all that good. And you can see bulls were disappointed. We started to rally up on 19, and bulls decided, this is not what I wanted to see. And they sell over their longs around break even, and then you get a big bear bar on 19. So this is caused by bulls selling out of their longs. That's what's causing 19. I think 19 is an okay swing short. A couple things. One of them is a lot of times when you're swing trading always in, if the market direction, if the always in changes quickly like it did here, you can take the other side. You can reverse your position, and you'll probably be able to make back whatever you lost. So if you bought above here or above here and you flipped below here to short, there's probably a 60 to 70% chance we're going to get to this 14 high. And there's a 90% chance we're going to break out of the 18 bar range. So you can sell below here, and you pretty much catch all of bars 20 and 21. You might scalp some here, but then you can see 22 reaches the new low, and we get the breakout of the 18 bar range, and there's buyers. But if you sold below here, you definitely made up for whatever you lost buying here and exiting here, and you probably made some money as well. So with all that being said, good sell below 19. Kind of a sell the close bar on 20. Definitely a sell the close bar on 21. Sorry, my throat's really dry today. And obviously, like I said, bad follow through on 22 because we're going to find buyers at that new low. 23 is an inside bar. Some bears might sell it. If you traded quite literally from always in, you're not out of your short yet. So it's probably okay to sell below 23, but it's really hard to want to do. You're selling the bottom of what could be a bear channel or a trading range. So I don't think it's necessarily great. And then you get bad follow through on 24 because, if you're selling below 23, you want a bar that looks basically like, 21. If you're going to sell below this, you just want huge follow through. And 24 is disappointing. It didn't successfully break out below 22. It tried and it failed. And so what happens on 25? If you sold below 23, your entry price is 41.75. Those traders are disappointed in 24, and they're exiting at break even during 25. And you can see it went one tick past that entry price, and then it got bought up because the bears who are disappointed in this are buying back their shorts. Bad follow through on 25. It's a double bottom for the bulls, but bears are thinking it's probably going to be a bear flag, and we're going to get a second leg down from this. But something you have to be thinking about is why is this here? Why did 15 and 16 exist? Right? These are super strong bull bars. These are as ideal of bull bars as we get. So even if we get the downside breakout, this doesn't just go away. This is, unless bears did something really, really dramatic, this doesn't just go away. And they did a good job of reversing the move from 15 to 16 with bars 18 to 21. They did a good job of reversing the move. So they'll probably, it's reasonable to think that they're going to get another leg down. But once they get that other leg down, you still have to be looking at this and thinking, is this going to happen on a strong bear trend day? It doesn't seem that likely. It seems unlikely that this would be a strong bear trend day. So it makes you think, if this is not a strong bear trend day, it's obviously not a bull trend day. So what is it probably going to be? It's probably going to be a trading range day. And on trading range days, a lot of times you get vacuum tests of the open of the day. And this was, the open of the day was a pretty far away magnet. But when you see a big reversal, down here, a little bit past the midday reversal window, but when you see a big reversal down here, after you got such strong bars earlier, you have to be wondering if we're going to get a swing up. And additionally, this was an expanding triangle, but it's still a triangle. And the apex of the triangle was bar 30. And bulls will buy below bar 30 because it's a doji bar and a bad sell below. Generally, selling below a doji at the bottom of a trading range. And those bulls got trapped. They got trapped on 31, 32. But they think if it's a trading range day, these traders should be able to get out at break even. So you can buy above here thinking 60% chance we're getting here. And, you can just continue to hold, hoping we get a bigger rally. Where was I? I got pretty sidetracked there. Okay, 26. So 26, bad follow through for the double bottom. And then you get 27. Pretty much any bulls who bought up here for any reason going to be selling out, causing that. It's a tight trading range is the main thing that you should be looking at here. The bulls who bought below 26 should make money after 27. So that's why you get 28. All those bulls buying. And we get back and test the close here after the pair of bull bars. And we start to find sellers. Doji on 29, doji on 30, essentially a failed breakout. The correct stop, once you start to get down here, like especially once you have the close of 27, the correct stop is above 22. So the correct stop, if you're a bear, never got run. So technically, if you sold below here, you're an always in trader, you never quite had to exit until, you probably should exit above 36, but I don't think you have to exit until maybe like 43. You're going to get stopped out above there. And that, sometimes you could argue you should have it above the top of the sell climax, but I think it's probably okay to just have your stop here. It's a triangle. It's a triangle late in a bear trend. So you have to be wondering if it's a final flag and if we're going to get a bull breakout. But anyways, bulls got trapped below 30. Big follow through for the bears on 31. Big follow through for the bears on 32. A lot of bulls disappointed 31, started selling out below 31. If you bought below 30, 31 is obviously, pretty bad, pretty terrible for you. You wanted to see something much better. And you have to keep in mind, most of these gaps are probably going to close. So did we reach the 18 low? I don't think so. Yeah. Most of these gaps are probably going to close. We have a big open gap here. It's probably going to get closed. Again, this low is probably going to get touched. And so as strong as this looks, you're trying to break out below a bear channel. That's usually not going to be successful. And then you get 33, a bull bar, and then you get a big follow through bar on 34 for the bears. But it makes it look like two legs down. And if this is so strong for the bears, why is there this bull bar? It just breaks it up. It makes it look like a trading range and a parabolic finish to a trading range. 35 bull bar, but not all that great. Obviously, you think the bulls who buy below 33 are going to make money, but it is a bull inside bar, so might be some traders exiting above. You get follow through on 36, and a couple reasons why you get bad follow through on 37. One is we're touching the 33 low. So bulls bought below 33. They scale in lower. Obviously disappointed in 34. They're exiting around break even. Another reason is if you look at 36, 35 and 36, what does it do? It goes up on 35, down on 35, and then up on 36. It's a two-legged correction. And so it's a two-legged correction in a bear trend. So it's not surprising that we're getting bad follow through, especially right at resistance. And that's one of the reasons you get a big bear bar below on 38. Bad follow through 39. The bulls who bought below 37 make money. 40, more follow through for the bears, but it's really not ideal. It's forming a triangle and you're at the bottom of trading range. Low probability breakout to the downside. 41, doji follow through. Then you get 42. 42 is a signal bar for the bears, hoping that we're going to get a downside breakout of this triangle and a measured move down, but very low probability of that. And when it doesn't immediately race down on 43, those bears start buying back their shorts in a panic, and that's what's causing this massive drive up and essentially creating the expanding triangle. However, so at this point, once you see this big bull bar, you have to be thinking about how strong this spike was. And you're thinking, well, we got a good bull close here. This is probably a trading range day. This 30 low is probably going to be a pretty important magnet. But we're not just going to go straight up because you have this steep bear trend line and we got the first trend line break 44.45. So we might need to test down one more time and get another reversal up. So you get essentially a low one attempt below 44, bad follow through, and a low two below 45. It's a low two, and you're right at the moving average, so it's a low two in a bear trend. So I don't sell below bull bars personally, but I'm sure there are better traders than me who are selling below 46. And you get big follow through on 47 closing near its low. It's tempting to look at this and think, oh, we're gonna collapse. But the reality is we're at the bottom of what's probably an expanding triangle. It seems a lot more likely that we're gonna get bad follow through than anything else. And you get bad follow through on 48. 48 is not quite able to close near its high, which is disappointing for the bulls. Bulls wanted it to close near its high, and they would have bought above it. But instead, you get bad follow through outside up, or sorry, bad follow through. Sorry, not bad follow through. You get a big tail on the top of the bar, and then you get bulls willing to buy below the bar, but not necessarily above. And we essentially get vacuumed down to that measured move I was talking about earlier, the bull flag measured move, and then a reversal up on 49. 49, you have the major, you have the trend line break, and then the lower low major trend reversal on 49. Sometimes you get a higher low before you continue up that much, and you could argue that that happened on 60 because it's one pullback, two pullback, three in a wedge attempt, but you get a failed breakout of the wedge. Why does the wedge fail? Well, probably because this is a bull micro channel. So you can see we never traded below another bar until 58. So we went from 49 to 58. So we had a 9-bar bull micro channel. So it's a tight channel. So it's probably a breakout on a higher time frame. So I don't think selling below 58 is all that good, or 59. I didn't even think always in bulls had to exit. Some might, but I don't think it was necessary to exit. And I just want to see something. Okay. I don't think it was necessary to exit below 59. And then you get 60 and you start thinking, well, this is a tight bull channel. It's probably a trading range day. Maybe we're going to get a breakout above the bear flag. You see it just like how we got a breakout below the bull flag. Maybe we're going to get a breakout above the bear flag and a measured move up. And hopefully, what you're thinking we're getting here, well, we're probably going to get there then. So what ended up happening was it was more of a leg one, leg two, something like this. So it was more of a leg one, leg two measured move, which is just a slightly weaker version, a slightly weaker measured move, if you will. So not all that surprising that we ended up getting that leg two. But anyways, 49, probably a reasonable swing buy. Bad follow through on 50, probably because we're getting back to the 46 low. And after this, it's reasonable to think that there's going to be sellers here, but not really any reason to exit. I think, if you're taking this, it's not super high probability to at best 50-50. So reasonable swing buy, bad follow through. And then you get a good follow through bar on 51. There's a tail on the top, so you might have to be worried about one, pullback two, and a second leg trap up here. And with a tail on top and it failing to break out of this trading range. So that's why you might be thinking, well, this isn't as strong as it could be. You get more follow through on 53, but again, big tail on the top. Still okay to be long, but not as good as it could be. And it not being as good as it could be in here is probably one of the reasons we weren't quite able to make this magnet. The strength early on in a bull trend is extremely important. It shows how strong the momentum is. And that's why when you get things like this that are pretty rare, you get excited. I bought above 15 and I added above 16, and I was very, by excited, I mean, I was feeling urgency. So I was feeling urgency to the upside. I was thinking, there's a couple of runaway winners a week, and you start to learn to see the setups that could potentially be them. And I was thinking on 15, I was like, this could be a good setup. And then we got good follow through on 16. I was thinking that could be a potential runaway winner. And when you get a potential runaway winner and then it disappoints you and you get a quick flip in the other direction, you got to be thinking, this was my mistake. I sold here, but I ended up scalping out. And basically just made back what I lost on this, and plus a little bit, but basically lost here and then sold below here. Took my loss below here and reversed to short and then scalped out. But if I had held, there's no real reason to exit in here, and you would have made obviously a lot more. and it's reasonable to do. 53 inside bar, reasonable to buy above the inside bar, hoping for another leg up. It's a high one in a bull trend. That's still in the spike phase, so it's okay to do. Follow through on 54. Kind of bad follow through on 55. We're starting to get towards this breakout point where there should be some sellers, and that's what ends up happening and causing the tail on 56. This is a tight bull channel. These aren't the best closes, so it's not necessarily as strong as it could be, but it's still a pretty strong bar, obviously, as it's an extremely tight bull channel. 57. So you can see we found some sellers at this 27 low, but more just bull selling it along because bears aren't that interested in selling. And with the bull micro channel, more likely not too surprised when we get this bar. It's a little bigger than I would expect it to be, but a good bull bar closing near its high. It's trying to test this magnet, the 30 low, and then you get 50, 58. 58, the bear argument is that it's 1 pullback, 2 pullback, 3, and it's a wedge, but it's a super tight bull channel, and we're probably going to test the apex of this triangle in the 30 low, and we're not close enough to it on 58 to have considered it tested. So I think that selling below 58 is not very smart. It seems more likely that the follow through is going to be bad and we're going to get back up here. So just keep your stop, at the bottom of the bull channel. I would say the channel technically started here and that this was more of the spike phase. Reason being, it's a high one, and you can just, this is more urgent and this seems like acceptance of the price almost. I'm not explaining this perfectly, but when you get that high one inside bar, to me, I think that's probably the bottom of the channel where all these tails are. 60, it's a high one buy. You get bad follow through here, and you probably have some trap bears who sold below 59. So, and some bulls might exit below 59. You definitely don't have to, but some might, and you get an outside up bar on 30 or on 60. So a lot of those bulls will buy back their longs above 60. And that causes the big bull bar on 61. 62, it's an inside bar, and 63 is an outside bar. So it's an inside-outside pattern. And like I already kind of mentioned, you start to get, follow through up here, and it gets more and more climactic. It's okay for bulls to be long, but you need to have a really tight stop, and those tight stops are the reasons why these climactic moves in the other direction happen. Like you get outside here. I'm just trying to think. Like there are sellers above this bar because there's a doji. There's sellers above here because it's a bear bar. So bears are going to sell above these bars, thinking that they're going to be able to make money. It's going to pull back, and they're going to be able to make money selling above these bars, and they're right. So that's why, some bulls will sell up below 68, some will sell up below 69, but bulls are selling out here. So it's okay for bears to get short and hold short, basically, obviously. And then I already talked about what happened down here. For always in, I thought it was always in long on 15, and then probably always in short below 19. Stayed always in short. If you exited for, some traders will get out in here, worry that we're going to get a bounce, and they can sell again below 31. Or 32. Disappointing follow through on 33, but you get another leg down. Bears probably exit above 36. They might sell again below 38, but you're pretty low in a bear trend at this point, so it might not be all that great, but it's probably still technically okay to do. Always in, clearly always in long on 49, I think, or trying to be always in long, and clearly always in long by 52. And then bulls exit below here, and bears can sell, always in short below there. These are good buy the close bars. It's good sell the close here, sell the close here, and then this is all buy the close. This is all sell the close. So a pretty easy day for stop order traders for the most part. On the daily chart, we got some follow through for the bears who sold below this low one. So I think that the bears will probably end up scalping out, but for now we have really solid bear follow through. So it'll be interesting to see what we get tomorrow. When we try to get, I assume we're probably going to try to get below yesterday's low or below today's low at some point tomorrow. And it'll be interesting to see if we get strong follow through. Something else to note is, as trends go on, they get weaker. And you can see this breakout point when, $12.80 below that breakout point. And this one so far is, $8.50. So I don't think we're going to get down too much further because this trend should get weaker as it goes on. And again, it's potentially bears trying to get a breakout below the bull flag. It's pretty parabolic though. Low chance that we vacuum straight down here. I think very low chance. I think more likely, it'll be interesting to see because tomorrow's Friday if the bulls can put a big tail on this bar. Bulls want to put a big tail on this bar and make it disappointing for the bears who sold below here. but they have a lot of work to do. So yeah, that's the day.